Hi there, this is FX Explained, and this is another Master Academy with Steve Miley. And in today's Master Academy, we're going to take a look at different trading terms. So the trading terms we're going to take a look at are fairly simple. They're fairly introductory, basic terms. Buy and sell, long and short, bull and bear, and risk on and risk off. So first of all, we're going to concentrate on buying to go long. What does that mean? Well, it means buying an asset to actually go long and own the asset. Going long means we own the asset. So in this case, we're looking at Alphabet. Alphabet is the parent company of Google. And if we go to buy to go long at, say, this situation here, this position here in the market, we're looking then for the market to rise. And in this case, we did well and the market went higher after we bought to go long. So that's buying to go long. So initiating a position. Now we're going to talk about selling to go short. Selling to go short means we sell the market in here, selling stocks, selling Google, selling Alphabet, and looking for the market to go lower from initiating that short. So we're short the market and looking for the price to deteriorate, the price to go lower, to profit from it being lower than when we initially sold it. So we're selling to go short. Next, we're going to do talk about a different type of buying, and that's buying to cover a short. Let's say we'd already shorted it in our last example up here. Now we're going to buy to cover that short. It doesn't now mean we're long. We're buying to cover the short, and by buying to cover the short, we now have a neutral position. So we were short, we buy, and now we are flat neutral. And in this case, having sold up here, we made a profit. And again, we're now going to look at selling to cover a long. So again, if we bought previously down here, as we said, buying to go long, and then the market rallies, goes higher up to here, and then we sell. We sell to cover the long. Selling to cover the long, now we have a neutral position. We're not selling to go short, we're selling to cover the long, and so we now have a neutral position in the market, and we profited from the market having gone higher. The next two terms we're going to talk about are bull and bear. Bull and bullish. A bull is bullish. What does a bull being bullish mean? A bull being bullish means they expect the market to go higher, whatever that market might be. In this case, again, we're looking at Alphabet, Google. We're looking for the market to go higher through this scenario here. So a bull would be bullish, looking for the market to rise in price. And conversely, a bear is bearish. They want the market to go lower. So they're looking for the market to deteriorate in price. And again, this could be on any asset class. A bull wanting the price to go higher, being bullish, a bear wanting the price to go lower, being bearish. We're now going to take a look at risk on and risk off, which sometimes get confused with bull and bear. They're not the same thing. Risk on means traders willing to take more risk in the market. So they're willing to put on more risky trades, to enter trades into more risky asset classes. That doesn't necessarily mean they want the market to go up. So in a risk on scenario, traders or investors are willing to take more risk. They have a greater risk appetite, and so they have a more positive outlook in the economy. They might buy more risky assets like buying stocks, but they may sell stocks, okay, in a converse scenario when we talk about risk off. So we're talking about buying in risk on, buying stocks maybe, but we could also be selling bonds in a risk on scenario because they are more seen as a safe haven. Now let's talk about risk off. In a risk off scenario, we're talking about traders or investors less willing to take risk. Their risk appetite is less. They have a lower threshold for risk. That usually comes with a negative outlook on the economy. So in this scenario, what we would see is we would look at traders looking to maybe take less risk, selling equities and buying bonds, buying the safe haven. So in this Master Academy, we've taken a look at these various trading terms: the buy and sell, the long and the short, the bull and the bear, and the risk on and risk off scenarios. This has been Steve Miley for FX Explained with another Master Academy. Please join us again next time. If you have any questions about this article or this video, please leave a comment below and I'll come back to you.